When it comes to properly designing a cash value life insurance policy, there is a lot that goes into it. We talk about this topic, policy design, more than anything else. Where can your money go? Base premium, PUA rider, being aware of the different limits that insurance companies offer, the IRS and their MEC limit, which in the near future will change. Well, it has already. The laws have at least, but the insurance companies have not updated that yet. My point is, there's a lot of information here. So if our goal is to take out a whole life insurance policy and I am interested in maximizing the cash value, what do I have to know? How can I ensure that it is set up properly? What questions do I ask? What things do I look for? Where do I start? Because there's so much in the industry, there's different agents, there's different companies, there's different opinions out there. Where can I get the information? This video is meant to provide information. So let's get into it. We're going to go through three topics here. We've got the company, so insurance company selection. You do not need me or anyone to tell you that there are a lot of insurance companies out there. If I want to buy life insurance, there are more companies than I can count. It can be a bit overwhelming. So if my goal is, again, taking out a policy and designing it for maximum cash value, what companies actually allow me to design policies for maximum cash value? Which ones have a track record? All that good stuff. We're going to get into that. The product selection. So when I hear the word whole life insurance, that is a product, but there are many different variations of that product. We're going to get into detail on that. And then also, you've got policy design. This is my favorite piece as far as when I design the policy, being aware of the different features, the mechanics. How do I set it up where I know that it's designed for two things mainly? Again, maximum cash value. That's the purpose of this video. And then also maximum flexibility. You know, when you hear the word life insurance, typically what comes to mind? Premium, bill, expense. I keep paying it forever, and because it is a life insurance policy, when I die, at that point, money is eventually paid out to my beneficiaries. It is a life insurance policy. However, if I'm interested in the cash value, and I don't want a boring bill where I just keep paying the same amount in, how do I turn that life insurance policy that has so many benefits around the cash value into a flexible savings asset where I can bounce my payments up and down? I can fund for a short period of time, long period of time. Perhaps I have a lump sum and I want to design it where I get the lump sum into a policy and then I'm done. Maybe I want to keep adding. How do I make it flexible is my point. And that can absolutely be done, but I've got to be aware of the information up front. And if you say, hey, just show me some different options, numbers, so I can see the strongest cash value product, guaranteed and non-guaranteed. I'll always stress, look at the guarantees. We can absolutely help you with that. Reach out anytime. We'd be happy to work with you. But if you'd like information first, let's get into it. Let's begin with the insurance company. So we mentioned that there are a lot of insurance companies in the US alone that we can select. When it comes to a whole life insurance product, designing it for maximum cash value, a couple things I want to be aware of here. One, you see mutual carrier. It is certainly in your best interest if you're in the market for whole life insurance and cash value accumulation is your point of interest. That's the name of the game. A mutual life insurance company will certainly provide the greatest potential. They have historically, they've consistently produced the strongest cash values to consumers and still do. To take that a step further, we often talk about different insurance companies to provide information. And all companies, small and large, have pros and cons, advantages and disadvantages. You name it, all companies have it. Or I should say some companies have it, some companies don't have it. When it comes to a company selection, what I like to look at, this is a huge, huge selling point in my opinion, is proof of performance. If you've ever been proposed a life insurance policy, for whole life insurance, cash value was the name of the game, that was the selling point. You likely saw an illustration, and over time that cash value looked good. Hey, look at the growth here, grows tax-free, you can access tax-free if you don't trigger a MEC or anything like that. Several benefits. But the thing is, it is an illustration, and as time passes, those values change. Typically, what is illustrated as far as the top end values do not pan out. we see lower actual cash values than what was projected. And that leads a lot of times to buyer's remorse, consumer dissatisfaction, and negativity that frankly no one likes. So when it comes to proof of performance, we offer companies that have provided proof of performance. You've heard me say, if you've watched any of our videos, likely the big four or four major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The main reason I like those carriers and talk about them so often is really because when you look at real data, not projections, but actual proof of performance, they've disclosed policies from different time periods and their net internal rates of return. What did the cash value grow to over time? What did the death benefit grow over time? Here was the projection, here's the actual results, with well-designed policies as well. And then of course we stress test these too. When you look at corporations and banks, when they purchase a policy, they put a lot of emphasis on proof of performance. They want to see the actual performance over time, not just a projection. Very important here. And anyone we work with, whether I'm working with someone looking to put in $10,000 per year or $1 million per year, or if it's a bank or corporation looking to put in 7 or 8 figures, whatever the dollar figure is, it's all equal in the sense that we want to make sure that the product is maximized for cash value, which always results in minimum compensation, by the way, to us. But with that said, I want the proof of performance. I don't want to just put someone in a product or put myself in a product that might deliver. I want to see proof, so we've got more certainty there. And that's where looking at the guarantees helps as well. The financials and size, along with the ratings, that is important as well. I do like financially strong companies, stable companies that have been in business for a long time, for 150 or 160 years plus. And you'll see a lot of those top companies in that arena. Now, I mentioned the 4 major mutual companies. That's not to discount any other company. We're speaking with other companies presently, and some of them have been very transparent and are making a ton of strides forward, providing information as far as, hey, here's our actual performance, or working on that. And as we obtain that, we will certainly make it available to what we can make available from a compliance standpoint. But company financials, size, ratings, all of that is very important as well, like it would be with any institution or anywhere I'm looking to position my money. Flexibility. So this kind of ties into the product, but companies have rules and restrictions around flexibility with their whole life insurance products. And what this means here, to get into the meat a bit, is when we set up a policy, where can your money go? Premium or the PUA component? Some companies are very, very liberal and very flexible when it comes to adding money into PUAs. We can add funds in at leisure, whereas other companies say, hey, whatever your initial payment was, we want you to stick to that with your whole life insurance policy. If you want to add money into PUAs, which primarily accelerate the cash value growth immediately, we may want you to go through medical underwriting again. And that's the kind of stuff that is good to be aware of up front. That consumer awareness is very important to eliminate any chance of buyer's remorse. How do I get creative and flexible with this product? How do I have enough knowledge or work with someone that has the knowledge and can communicate that for me, or to me properly, or take care of it for me, I should say. The product. So with whole life insurance, there are a lot of products. We've got a list here. We've got a product series on our YouTube channel that goes through these different products here. But the core whole life products you will see are as follows. You've got traditional, higherly cash value, hybrid, limited pay, and survivorship. To go through these quickly, a traditional whole life insurance product may be called a life paid up at age 121 or legacy 100. A policy, if you see that name, 121, 100, life 99, what that represents is the age I can pay into the policy if I wanted to. So for example, with a life paid up at 121, that means premiums are payable until I'm 121 years old. Now, who's going to pay in? Who's going to live that long, right? Let alone pay in that long. So premiums are payable that for the life of the policy. traditional whole life insurance policy, again, Legacy 121, for example, or L121. But the one thing I want to emphasize here is that does not mean that I'm committed to, in all respects, to making payments that long. I can easily stop payments early through what's called a premium offset or a reduced paid up option. What this does is allow the policy to pay for my premium on its own or cut the premium off altogether and make it paid up early on. So some flexibility there. I know this can be difficult to grasp conceptually, but we've got several videos that provide more detail as well. But a traditional policy with those two areas, right, I can pay money where? Toward the premium or PUA component. With a traditional whole life insurance product, the premium is typically overcharged in the first and second year. So if I have a $10,000 base premium with a traditional life paid up at age 121 whole life product, I will see zero or very, very little of that base premium show up in cash value right off the bat in the first and second year. Beginning year 3, typically, I see that premium come back to cash value, start to build equity, and it gets better and better. High early cash value products. Those typically credit 90 to 95% of the base premium in cash value in the first year alone. And I can add PUAs on top of that, just like a traditional product. Very attractive in that respect up front. However, it's kind of in the name, high early cash value product. Very, very strong early cash values, but when we look at it over the long haul, not quite as attractive. The insurance company does not overcharge me for the premium up front. Instead, they spread the cost out over the life of the policy, but it's a bit more expensive. But again, it's good to see these options up front or be aware of them as a consumer. That way I can see it all and then make an educated decision. Same thing if I'm an agent. Show the options. This way we don't show one option and then your client finds out after the fact about a different option they may have gone with. Show it up front, just like they could see it on Amazon. A hybrid product, this is kind of in between the two, where the company might only overcharge me in the first year for the base premium, and then as time passes, I don't give up as much over the long haul as I would with a pure high early cash value product. A limited pay product, a great example of this would be a 10-pay policy. So with a 10-pay policy, premiums are due for, guess what, 10 years. After that, the policy is fully paid up. Even if I wanted to add premium after the fact, I could not. It's paid up. Just like a L100, a life paid up at age 100 is paid up. No more premiums can go in at age 100. Same thing with a 10-pay. After 10 years, I'm done. Now, the cash value and death benefit will continue to grow. That'll appreciate over time as dividends are kicked back into the policy. I can borrow, I can repay, I can borrow, not repay, I can take income from the product, I can still use it. The only thing is that I have a guarantee with a 10-pay product here that after 10 years, I don't have to pay anything in anymore. Guaranteed to be fully paid up. Now the thing is, you can do that with a traditional product, a high early cash value. You can exercise what is called a reduced paid up option, which turns it into very similar to a 10-pay if I were looking at that as a sample. But all products have pros and cons. And then a survivorship policy, that's nice to be aware of. That is one policy on two individuals, typically a couple, you and your spouse for instance. And the disadvantage, there's two disadvantages in my opinion, to touch on the negative point first. One is on the death benefit. The death benefit is often not paid out until both insureds die. So it's one policy on two individuals. Both of them have to die before the death benefit's paid out. The MEC rules are also different on survivorship policies. Often with a single life policy, the MEC limit is referred to as the 7-pay premium test. I can cut that term rider after the first 7 years. Can't do that with a survivorship. Much, much more challenging. I've got to be more aware of the death benefit, MEC treatment. If I'm paying in for a long period of time, or that's my intention, it can work well. Or if I have a large sum of money, I'm getting into a policy. But it's good to be aware of the MEC dangers with these policies, because there's certain things you cannot do as time passes. So those are the disadvantages. Death benefit pays out after both people die, and then the MEC testing is a bit different. The advantage, however, especially if cash value, maximizing cash value is the name of the game for you, is this. Because it is one policy on two individuals, the insurance company knows that there is a very, very good chance, statistically speaking, that they're going to hold on to that life insurance claim longer. They know both people have to die. Chances are very, very high that one dies first and the other lives for another number of years, whether that's 5 to 10 or perhaps longer. So as a result, the insurance expenses are often less than what you would see on a single life policy, and the cash value has greater earning potential as time passes. So pros and cons there. It's a good option to be aware of. Doesn't always fit, but again, being aware of it, it might fit your particular situation. And then policy design. So our next video, we're going to actually go through how to design a policy and being aware of a lot of these limitations and such. But this is my favorite part. It's technical, but we continue to try and refine it to simplify here. So the most important thing to be aware of with policy design are the limitations. Where can my money go? Two primary areas. You've got the base premium or the PUA rider. The base premium, like we talked about with a traditional life insurance policy, first the company overcharges me for the death benefit up front. So with the traditional whole life product, you might see zero in cash value, call it in the first and second year, because the product buys me a death benefit. However, as time passes, premium dollars do come back to cash value and start to earn dividends and interest. Whereas PUA dollars show up in cash value right away, start to accrue dividends and interest. It accelerates the cash value growth of a life insurance policy. It does purchase me what is called paid up additional life insurance. PUA stands for paid up additional. It buys me more whole life death benefit as I make deposits as well. I've got a term rider. This is a great way to raise the next piece here, my MEC limit, in the most cost-effective manner. A term rider purchases me more death benefit, typically at a very low cost. The next video you will see that. But the MEC limit, so this is an important limit to be aware of. And again, this is going to change a bit with the new tax law that just was released as changes actually come about, is MEC stands for Modified Endowment Contract. Why so many people are attracted to cash value life insurance is what? The tax benefits. If I do everything properly, that money will grow tax deferred and I can access it tax free. That's why so many people position money in cash value life insurance. Now, if a policy becomes classified as a modified endowment contract, tax benefits are out the window. It still grows tax deferred. The death benefit's still paid out income tax free, but if I want to access my cash value, I have to deal with ordinary income tax in respect to the gains only, and then also a potential 10% penalty tax if I touch it prior to age 59 and a half. Good to be aware of that. So I've got to make sure I don't trigger this modified endowment contract, so every policy has a MEC limit. And what you'll find is that MEC limit has a direct relationship to an individual's age and total death benefit on a life insurance policy. So when we design a policy, what we're looking to do is set it up in a manner where we can minimize the insurance company expenses, premium, the product, get it set up for maximum cash value, but also ensure that it still remains life insurance from the viewpoint of the IRS and not a pure taxable investment. That ruins everything. I don't want that. And then we've got the death benefit. So this does have a relationship to the MEC limit, like we just said. But having an understanding on that, one, it's paid out income tax free, but with the policy design, we'll often hear, hey, Steve, I don't care about the death benefit. Like cash value is why I'm buying this. That's what I'm interested in. Can we just set the death benefit at nothing? Well, it's important to understand we can't set it at nothing, but how do we get it as close as possible, knowing that it has a direct relationship to that MEC limit? That's the key, so I can still keep the policy classified as life insurance. So a lot of information here, just things to be aware of. If you have follow-up questions on any of this or ideas, or if Steve, or say, Steve, can you create another video on a certain topic? Let us know. Always happy to work with you or create videos. Love the feedback that everyone has provided, or provides, I should say. But I do hope this helps, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.